I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. How's it going, everyone? Welcome back to the show. Today, we've got Rick Rule, who has devoted over 50 years to natural resource investing. He also recently started a bank, his seventh, which is pretty cool. He has a pretty robust background in the world of private placement markets and has participated in hundreds of debt and equity transactions. Rick, welcome to the program.
Hunter, it's a pleasure. Thank you for inviting me.
In the world of finance, there's like this little golden pathway. And if you play your cards right, you get to play the role of the bank, right? And that means either as a lender or eventually owning a bank. And I was very excited to see that that's now your path and that's where you're at. Tell us about, what this process is like, what got you interested in this, and then this is not your first or second, this is now your seventh. So I want to learn everything you know, as quickly as possible.
Well, first of all, banking is a very, very, very good business if you don't make mistakes. You don't have to do everything right. It's just that you can't do much wrong. The basic business is that you aggregate deposits for people. You try to keep your non-interest expenses lower than your competition, and you try to lend money to people who will pay it back. Uh, uh, People get banking wrong because they get too greedy. They take what's basically a pretty good business, a leverage business, and they over leverage it, or they don't treat their customers well, or they let their expenses run wild, or more likely, they become overly aggressive with their loan portfolio and they loan in businesses that they don't understand. I approach banking the same way Ohio State used to approach football, which is to say, I focus on blocking and tackling. I don't try to be all things to all people. I try to figure niches in markets where I can serve the markets better than my competitors. People have said to me for many years as I've invested in community banks, Rick, how can you possibly compete with Bank of America? To which I say, I can't. And Bank of America can't possibly compete with me either. And I think that's important. Last week, I walked into the local branch of my big box bank. I won't name them. And I was met by a very, very, very nice branch manager who didn't know very much about banking. Warm, kind, genuinely nice person. And I think about the benefit that I got from that branch, which is to say zero. And I think about the fact that that bank has, as a consequence of their branch banking network, 150 basis points, 1.5% of non-interest expense that my banks, not having branches, won't have. If you think about the fact that the bank's gross interest spread, if they're doing a good job, is 4%, 450 basis points. If you take away a third of their spread at the beginning of the exercise, you understand what I'm saying about blocking and tackling and focusing on the big things. The last bank prior to this that I was involved in was a highly successful internet bank called Everbank. Some of your listeners will certainly remember that bank. It was one of the first of the internet-based banks, and it grew from inception in 1999, over 14 years, to an institution that had 275,000 depositors and $28 billion in deposits before it was sold to TIAA-CREF. How did they do that? Well, first of all, rather than offering 10 or 15 deposit products, many of which were intended to baffle their depositors, and many of which paid no interest, Everbank had one deposit product, a high-yield money market account that you could write checks on. In other words, they paid you interest on your checking account balances. In other words, they treated their customers right. The second thing is that they spoke to their intended customers and found out deposit products that were of useful to the customers. And the consequence of that is that they unveiled a program where you could save in 28 currencies outside the US dollar, but still enjoy federal deposit insurance. You could save in Canadian dollars, in Japanese yen, in euros. And that was important to the first generation American businessman or woman who might operate part of their business in euros and part of their business in dollars. In other words, a population that had an incentive to save in two currencies. No other bank was doing that. And that ended up being a very important deposit product. Having served deposit well, the depositors began to go to Everbank and said, "Do you guys do mortgages?" If you think about it, if your customer acquisition cost is zero, in other words, if that customer is already a customer of yours, you spend no marketing expense, you have a durable competitive advantage in customer acquisition. And that was the virtuous circle that Everbank enjoyed. It didn't try to be all things to all people. It tried to service one audience extraordinarily well. In 2014, Everbank was sold to TIAA-CREF, great organization. The marketing that had made Everbank so unique wasn't necessary for TIAA because they already had 1.5 million members. They didn't have to market. But what happened then is that the product preference of those customers differed from the product preference of the traditional Everbank customer. The TIAA-CREF customer was traditionally a retired school teacher, and TIAA-CREF had really been an annuity sales organization before that, which meant that all of the really innovative deposit products and lending products that originated by Everbank died on the vine after TIAA-CREF took over. There was a 275,000 person deposit community that was left orphaned. And that's what led me to back the team that had built Everbank and left it after the takeover to start a new bank. What'll be different from other banks here? Well, the same thing. One high yield money market deposit product. We're not going to try and baffle you with 16 deposits, 5 or 6 of which purport to pay you no interest. We will also offer certificates of deposits initially in 20 currencies. And as an example, if you have a Canadian dollar account with us and a US dollar account with us, you will be able to do currency transfers for 50 basis points rather than 200 basis points that your existing bank charges you. The next feature will be of interest to real estate investors. We will offer what we call checkbook IRAs. Your IRA can own an LLC, and that LLC can own a duplex or a triplex or a fourplex. It can invest in a franchise. In other words, at Battle Bank, your IRA, pardon me, will actually be yours. It won't merely be a repository for mutual funds offered up by some insurance company or something like that. A huge, huge, huge difference for aspiring investors who want better banking. The third feature that'll be different is that Battle Bank will make what are in effect margin loans on holdings of physical gold, silver, platinum, and palladium. There are $33 billion that we've identified in privately held bullion in private storage in the United States. And there's no lender that seems to believe that gold is good collateral, when in fact it's hugely liquid. And a lender that had to foreclose on a borrower for non-payment could, in the case of precious metals, sell that collateral in 10 seconds. The idea that there's a $33 billion asset class that doesn't have a lender is astonishing to me. We found at Everbank that there was a strong correlation between aspiring investors who were technologically savvy enough that our branch could be their computer, and good deposit rates, good borrowing rates, and gold ownership. So what we hope to do at Battle Bank is service precisely that community, the same community that we served at Everbank. Often subscribers to independent investment advice like Agora Publishing. Very commonly, people who believe that between 2 and 10% of their net worth should be in physical gold or silver. People who want the ability to access that capital without having to sell their gold or silver, um, that's the community that we propose to serve.
How'd you get into this space? Is this the first banking relationship that you had? Is in the sense of, is all these seven banks, are they all because of this one transaction or?
No, no,
Okay.
no. I started investing in community banks really as soon as I had excess funds personally to invest, which occurred in my early 30s.
Okay.
Uh,
What did you do before
I
that? Just out of
saw,
curiosity.
yeah, I saw a series of markets that weren't being addressed, and I saw some entrepreneurs who had the ability uh, to access them. Uh, Usually in community banks, community is defined by a local piece of geography. So, as an example, I was an early investor in Torrey Pines Bank in North County, San Diego, and benefited tremendously from the growth of that market, but more particularly from the depth of experience that the team that built Torrey Pines Bank had with that market. Again, they couldn't compete with Bank of America, but in that chosen market, Bank of America couldn't compete with them. I invested in a couple of small energy lenders in the 1980s, after the oil and gas space had been decimated. Capital that was available to the oil and gas industry had declined really substantially, and there was a huge hole in the market for banks to come and help family-owned firms or family offices in the oil and gas business get ahead. These weren't banks that were lending to the auto industry or the supermarket industry. These were banks that had a specialized focus. That's always what I've wanted to do in banking. I've wanted to find communities that I understood that weren't adequately serviced by their existing financial institution, and then help build a financial institution that could solve problems for a definable segment in society. The last two banks, Everbank and Battle Bank, are community banks, but not local community banks. They're community banks that, rather than focus on a region of the country, focus on a customer set that has certain values and expectations around banking. That is to say, a community bank formed more on ideology and preference than on geography.
Interesting that you brought up the Bank of America and the bigger banks. As a real estate investor, as someone that's created funds, fund of funds, buying assets directly, there are certainly some large banks that are not friendly at all to just those types of products. Have you dealt with, I'll put it this way. Why is that the case? Is that a regulatory issue? And regarding, the previous investments you made, is the regulatory environment such that it's very difficult to kind of conduct these businesses?
The regulatory environment can be challenging, but in fairness, these people, these great big banks, the JP Morgan Chases of the world, the Bank of Americas of the world, the Citicorps of the world, try to be all things to all people. They try to have expertise in 500 businesses, and they can't do it. They can't do it. And the truth is that they become monolithic in their compensation structure. A lending officer with 10 years experience is paid effectively the same in one market as the next, and there isn't any particular compensation uh, structure that compensates people for value creation and penalizes them for a lack of value creation. What that means is, let's say that I'm an apartment syndicator in California. I'm not, but let's say that I was. And I'm a Wells Fargo client. Uh, if I am lucky enough to get a multifamily lending operator in Wells Fargo that knows a lot about the California market, in other words, a good banker, I'll have a good relationship with Wells Fargo. But in truth, it won't be with Wells Fargo. It'll be with that banker. And in my experience, 50 years of experience as both a depositor and a lender uh, with major financial supermarkets, the probability that I get a high quality person is really random, particularly if I have the misfortune of going in through the branch. In a smaller institution where the employees are shareholders of the institution, And where, like as not, the president of the bank is on the credit committee, you get a very, very, very different level of exposure to expertise. Now, the quid pro quo to that is that a small bank can't do very many things. You have to choose your small bank because that bank specializes in the service that you need. Outside of Battle Bank, which I'm building, I'm a shareholder in a little tiny bank in California called the Bank of Hemet. Uh, the Bank of Hemet, while small, is an extraordinarily high-performing bank. Number one, two, or three in most performance metrics that you measure banks on in California. Bank of Hemet does one thing. They make semi-permanent floating rate loans to professional and semi-professional real estate investors in the 13 Western states. That's all they do. A competing organization, a big bank, lending to somebody who has an experience with the bank, we've done studies of this, the average time from submittal to approval for the big banks is something like 75 or 80 days. At Bank of Hemet, it's something like 5 or 6 days.
Hmm.
That's their durable competitive advantage. They service one small community. Uh, they service them extraordinarily well. They can't compete with Wells Fargo, and Wells Fargo can't touch them.
When you think about this asset class from an investor's perspective, do you pool investors together? Like, give me some ideas of like the finance that is taking place here. Like, is it like a bunch of $50,000 investors? There's like two billionaires that you've met over the years. I think people are kind of removed from this. In my world of syndications, if you're raising $5 million or 10, it's easy to find, 150K investors. Is that similar to the numbers you're looking at, or give me a little bit of context
I
there?
used to do a lot of syndication, and I used to do exactly what you're talking about. You know, um, I mean, the last bank, it sounds strange, but we grew it too fast. We had to take it public. We had a very successful offering in the New York Stock Exchange. We did what we did. Before that, when it was funded at the private stage, what happened is that that bank grew so quickly that we had to go to the institutional investors, the financial services investors. In retrospect, that was a mistake. They were managing their money for liquidity, and they caused us to have to manage the bank on a quarter by quarter basis rather
Yep.
than running a fantastic bank. In this particular bank, there are three cornerstone investors, myself and two family offices, who anticipate being customers of the bank. And then we have raised money from public people that we knew who we hope will become good customers of the bank and employees of the bank. The fourth pillar shareholder is there is a private publishing company called Agora Inc., the largest financial newsletter publisher in the world by a wide margin. We had a good relationship with them at Everbank. We created deposit products that were of interest to their editors and to their readers. And ultimately, the relationship with Agora added about $12 billion in deposit to what was a $28 billion bank. The difference between this bank and the last bank is that Agora Inc. and their editors now own something just under 10% of the new bank. Their experience with us the last time through was good enough that in addition to using us as an investment solution for their subscribers, they have, as a group, decided to become shareholders of ours. And we look forward to all of our investors bringing us more than money. In terms of the family office investors, we look forward to being important banking solutions for those investors and their families. For the community of bullion dealers around the country who have invested in our bank, we look forward to servicing their customers when their customers have liquidity needs, but don't want to sell their bullion. My hope is that this bank never goes public. I certainly hope that we never need cash to the extent that we have to go back to the hedge funds and the professional financial services investors. My vision for the bank would be literally a community bank where the bank is owned by the community and services the community. Because as I say, it's a very, very, very good business. It's a business where if you don't screw up, uh, at least in the first 10 years, where you can earn after-tax returns on equity in the high teens and reinvest that money back in the same business at the same expected rate of return. Uh, my suspicion is that until the bank crosses $20 billion in AUM, that the bank, should the shareholders choose to, could reinvest uh, capital that is generating, say, 15, 16, 17% return on equity at the same very, very high rates. And it's that type of compounding that makes people fortunes.
That's true. Just give it a little bit of time.
Yep.
Double every 4 or 5 years, and you're going to create something pretty remarkable, especially if you're able to offset some of that by reinvesting.
Yeah. I
Um,
mean, it gets stupid in the out years, as you know. Buffett said that the greatest investment secret of all times is right out in the open. It's called compounding.
yeah. What about your economic view? The Fed has started to lower rates. They're in what people call like the lowering cycle, let's say. Of course, the treasuries have not responded in kind by moving in lockstep. What is your view on interest rates and how that relates to obviously the way most banks make money is lending? So I'd love to learn more about your view about interest rates and how that plays into your view.
I've seen this happen twice before in my career, where the Fed was deliberately jawboning interest rates down, and the market took over and moved them up. And in both of those circumstances, the times that followed were not easy.
Really?
Not easy. And I'm partially telling my own joke. I think that we're coming into a period that will be enormously lucrative for those who pay attention to it, and very punishing for those who don't pay attention to it. For reference, I think that the period of time that we're coming into most clearly resembles the decade of the 1970s. That was a wonderful decade for people who were prepared for it. It was a lousy decade for most of the country. Uh, how do I say that, and why do I say that? The first is that we have come off 40 extremely benign years. The period 1982 to 2022, you couldn't get much better. Falling interest rates, relatively strong dollar, the benefits of financial inclusion, the benefits of globalization, the demographics of the baby boomers, all that stuff.
Yeah.
Uh, I think that's over. And I think that people don't know it's over yet. So I think that there is an anticipation of the future that is set by people's experience in the immediate past.
Yeah.
And I think that experience is wrong. And any massive reset that society isn't ready for is jarring. But that's all rhetoric. Let's get to numbers. The on-balance sheet liabilities of the US government, that is what the US government owes to bondholders, is rapidly approaching $36 trillion, 29 trillion net of the Fed's own balance sheet. So let's round it up to 30 billion, 30 trillion. I'm sorry. I misplaced three zeros there. Easy to do when there's that many. That's scary enough. But this $30 trillion isn't being serviced. It's being added to the extent of $2.5 trillion a year. But that isn't the worst part. The worst part that your viewers can get an icon of by looking at me in the screen, a 71-year-old. The off-balance sheet liabilities of the US government, the net present value, not the nominal value, the net present value of off-balance sheet liabilities, Medicare, Medicaid, Social Security, federal government pension, military pensions, that number, according to the Congressional Budget Office, exceeds $100 trillion. And that number is increasing, depending on who provides the estimate, between $2 and $4 trillion a year. So let's add those two numbers. 30 trillion net on balance sheet, 100 trillion off balance sheet. That number is $130 trillion. The Internal Revenue Service estimates that the net private wealth in the United States is $140 trillion. So we're collectively worth 140 and we collectively owe 130. That's not too pretty. How do we deal with this? Is there any candidate that has the guts to say that we can't afford Social Security, Medicare, Medicaid, federal pensions, military pensions? None that I know of. So I believe that the solution, the political solution, will be to honor the nominal value of those obligations. In other words, you take some old geezer like me and you say you were promised $4,000 a month or whatever it is in Social Security. I don't even know. And we're going to pay you $4,000 a month. But what we're going to do is inflate away the net present value of that obligation so that the $4,000 that they spend you buys $500 worth of goods and services at the end of the term. When I said at the beginning of this discussion that I think that the decade that this resembles is 1970, remember that according to the IRS again, the purchasing power of the US dollar in the period 1970 to 1980 fell by 75%. If you inflate away 3/4 of the net present value of the nominal debt, then the $130 trillion becomes much more manageable. It is truly ugly for the person who believes that he or she is going to enjoy a decent retirement because they're doing their financial forecasting, believing that the retirement income that they enjoy today will buy them the same level of prosperity in the future that it does today. But it won't. And
What
listen, by the
about,
way,
yeah,
I hope I'm wrong. I really, 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 truly hope I'm wrong. But I don't understand how, as a society or as individuals, we escape that arithmetic. Remember that in 1970, and then again in 2008, I'm choosing shocking times, the on-balance sheet liabilities of the United States were, let me see if my memory is correct, 32 and 40% respectively of the GDP, the gross domestic product of the United States.
right.
Our on-balance sheet liabilities today exceed 120% of GDP. So our status as a debtor or our ability to engage in fiscal measures, quantitative easing, otherwise known as counterfeiting, I think is much more constrained than it has been in prior times in our history.
I'd love to learn more about the 1970s. I wasn't around, and I'd like to hear more about, look, we've talked about Volcker, coming in and hammering interest rates up. I'm not so sure that that's our path out of here. I thought that Jerome Powell, I was pretty surprised that he was so aggressive, to be honest. I don't know if that's going to be a thing of the past in about a year or so when he's no longer there. But what, from your view, was the combination of factors that led to that particular situation? And then as an investor, what is the playbook, assuming that is the case, that that's where we're headed?
Well, before Volcker, let me rephrase that. Before a consensus evolved in the United States that we had to deal with interest rates, we had already solved the problem. We had devalued the US dollar relative to its purchasing power to the extent that we had solved in the near term the net present value of Social Security and Medicare obligations. In other words, we had already diminished the standard of living of most Americans to the extent that the entitlements problem arithmetically was less important than it had been. Once we solved that problem, we could and did obliterate inflationary expectations by raising the cost of capital and cratering asset values. I was around for it. The other thing that we did is we changed the tax code a lot. If you were a real estate syndicator any time up to 1986, an important part of your consideration were tax shelters and tax preference because depreciation in real estate could be charged off against ordinary income. So, to the extent that you were generating extraordinary depreciation on an apartment building, it became extremely attractive to a doctor who was paying tax on 70% of his marginal income. The Tax Reform Act of 1986, for all its sins, did a pretty good job of ironing out 4 decades of congressionally inspired tax preference. Not that that was popular with the syndicators. They actually had to make money in real estate. But it made the adjustment, lower marginal tax rates, but an absence of preference. It made adjustments to the funding of the US government that had a positive impact for 10 years. It's probably one of the reasons that we survived in our current form.
Hmm. And did you buy deals with leverage at like 17% interest rates at that time? And if so, what do those deals look like?
And I was too busy trying to survive. In the funny story, I was an extraordinarily successful young man in the 70s because I happened to be in the right place at the right time. I had an interest in a facility for natural resources in a period where the gold price went from $35 to $850, and the oil price went from 2.5 to $30. The consequence of that is, of course, I thought I was a genius.
Yeah, I've been there.
A young man, let's just say that we're easy to hoodwink if we hoodwink ourselves. When those markets collapsed in 1981, end of 1981, I found out just how smart I was, which is to say, not very. And I got through it, but I got through it by the skin of my teeth. I wasn't able, I should have, I mean, a lawyer would have told me that I should declare bankruptcy. I didn't do that because I wouldn't allow myself to do it. But I spent 4 years, I mean, going into 1982, I went from being a very wealthy young man to having a negative net worth. And it took me 4.5 years to get back to zero.
Wow.
In the period where I wish I had been buying deals,
Yeah. Yeah.
because it was very clear to me after Volcker, when the prime rate hit 18, it was very clear to me that I mean, even as a young man, it was clear to me that inflationary expectations had been broken and the direction of interest rates was lower. And if you could find a deal that would pencil at 18, it was going to look sweet at 12. Which is what I thought would happen and what did happen to interest rates over the balance of that decade. Until 1986, was in no shape to participate. Mercifully for me, the end of 1987, we had a spectacular crash. The equities markets fell by 35%. And by then, I had the experience, I had the connections, and I had the cash to take advantage of a liquidity squeeze. And I'll tell you, Hunter, I was in with both feet.
Yeah. Well, it's a wild story. I appreciate you sharing. And it's funny, you can laugh about it now, you can joke about it, but listen, as someone who I'm sure your identity was very much wrapped in, hey man, everything this guy touches turns to gold, no pun intended, right? Like I know what that's like to be young and be successful, and that's who you are, and that's all your friends know you as that. And then all of a sudden that turns around. It's like, who am I? Forget the fact that financially I'm wrecked. Who am I? And to go 4 years for that, but then to turn it around, I mean, it's an important lesson in two things. Number one, everyone always looks at the chart and says, how easy would it have been to buy back then? Well, it's like, I don't know, because maybe you were going through personal bankruptcy, right? Like a lot of people were. That's why most people weren't buying. Listen,
It's tough to get 18% credit if you have a negative net worth.
yeah, 100%. One last one before we jump off though. What would be your outlook in terms of 2025, 2026? In my industry in real estate and multifamily in particular, the phrase was always survive till 2025. It's right around the corner. I've survived, maybe sometimes with the skin of my teeth. What is your outlook in terms of, investments, private placements, et cetera?
In most areas of real estate, it's going to get worse before it gets better. And conversely, for pros, it's going to get better before it gets worse. You have had to compete with people who didn't have to add value. They just had to buy something and hang on. That party's coming to a screeching halt. The tourists, the people who didn't know how to buy a strip shopping center and take it from 70% occupancy to 95% occupancy. The people who don't know how to add value after they buy a piece of real estate, these guys are toast. The wind is not in their sails anymore. Similarly, the lenders who believe that you couldn't do a bad deal in real estate are going to discover $100 billion in bad commercial deals. So the lending part of the business is going to become much less accommodative, but it's going to be much more focused on good operators. The high quality operators who have et al. Networks who trust them, who will fund them in bad times, and have the ability to understand what are really bargains rather than are just things that they can buy and add fees to, are going to have 90% less competition. I found in the oil business in the 1980s, after the tourists left, there was a lot less competition for good people, and there was a lot less competition for good product. Now, unfortunately, I had to get from 1981 to 1989. That wasn't so pleasant. But I think, the ma and pa syndicators that you see now, the CPAs, who, to be honest with you, don't know shit about single family residential, and don't know shit about mini storage, and don't know shit about strip commercial. Uh, they're going to go the way of the dodo. They're going to go the way of Tyrannosaurus Rex. And to the extent that you have the opportunity to look at a piece of property that's held by, an aging boomer like me, you're going to find that you're going to have much less competition on the buy side. And you're going to be able to do what that aging boomer hasn't done for 20 years. You're going to be able to add value. And if you have added value all the way along to your et al. Network so that they have the guts to follow you, uh, you're going to do extraordinarily well. And remember that if I'm right about the fact that the only policy response that we can have to our political crisis is to inflate away 75% of the purchasing power of the US dollar, the ability that people are going to have to build product that competes with yours, is going to be very, very, very low.
What do you mean by that?
I mean that inflation of all the inputs that goes into development,
Hmm.
labor,
Yes, yes,
material,
yes.
fees, is going to skyrocket.
Yeah.
What is today a building that's valued at $400 a foot is going to cost 600 or $700 a foot to build. They aren't going to be able to compete with you in terms of the delivery of service for the price that you, as a legacy holder, pre-inflation, will be able to deliver them. I watched this happen with mine own eyes.
Hmm.
I'm not making this up. I saw it.
Yeah, we've seen it at a smaller scale, right? Why interest rates had rose the way they did was because of inflation, even though it was short-lived and to a large degree not here now. That moment, what happened? Everyone immediately started making changes to their business, but it was very pronounced and dramatic in the world of development because of exactly what you're talking about. It wasn't just unique to the COVID risk and the supply chain issues. Those were unique in of itself, but the broader scope, that's what happens. The first thing to go is those who are most sensitive to those price increases, and developers would be one of those.
The second thing is if you have access to long-term fixed rate financing, Your return on capital employed, your nominal return on capital employed goes up as rents rise with inflation, but your cost of capital stays fixed. And where you actually make money over time is the delta between the return on capital employed and the cost of capital. I myself wouldn't be particularly interested in short-term financing or floating rate financing, at least in terms of permanent financing. I'd rather pay more now, pay the upfront fees, do whatever you have to do, lock in long-term financing, and then let inflation do a little bit of work for you, understanding that you need to add value now.
Yeah.
The wind isn't in the market sales, which means if you add value, the wind is in your sales because it exterminates the tourists.
That's true. And it always does feel like it's never going to go back to the heyday. And then all of a sudden, it feels like it's never going to go back to a day when you can make a deal pencil. And anything like I promise you, multifamily in particular, there's going to be a time when people are making money hand over fist and people are leaving college to go start their multifamily career because it's so lucrative. But that time I think is a couple years away. And so it gives you more time if you're listening to this show to develop your confidence, develop your network so you can be like he was in the late 80s. So listen, Rick, I really appreciate you coming on, man. This has been an interesting conversation about banking and economics and your outlook. Before we jump off though, let the listeners know how they can learn more about you, your bank, etc.
Well, two things. We didn't talk much about natural resources, but that's actually what I do for a living. To the extent that your listeners are interested in natural resources, the best thing to do is visit my website, ruleinvestmentmedia.com. If you are an owner of natural resource stocks, if you list them there, I will personally rank them. No charge, no obligation. Uh, if you own some companies that I know something about, I'll also comment on the companies individually. If you care about my bank, or if for any reason you're uncomfortable with your current bank, which I suspect is everybody that you talk to, you can go to battlebank.com or you can go to ruleinvestmentmedia.com and simply write down bank, and we'll send you information. If you're a depositor, we'd love your deposits. If you have an IRA, we'd love to show you how your IRA works for you as opposed to the big financial services business. If you are a borrower within our areas of expertise, we would love to battle for your business. That's what Battle Bank's all about.
Cool. We'll link to that in the show notes page. Rick, thanks a bunch.
Pleasure. Thank you.